Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel. I'm going to give you an updated Tesla stock analysis video today. At the time of making this video, Tesla stock is still down 27% from the most recent peak, but recently Tesla stock has already recovered around 45% from the most recent bottom here. Many investors want to know, is Tesla stock overvalued now, and is Tesla a great company for long-term investing? I'm going to answer these two questions in this video by covering these topics. First, Tesla stock's biggest risk going forward. Second, Tesla's economic moat and long-term prospects. Specifically, I will talk about whether Tesla will be able to sell 20 million vehicles a year by 2030. Third, Tesla stock valuation. You will learn about how to calculate Tesla stock's intrinsic value, so you will know whether Tesla stocks is overvalued, fairly valued, or undervalued now. And fourth, will I buy Tesla stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look. Let's start. Before talking about Tesla's competitive advantage and long-term business prospects, I want to talk about Tesla's biggest risk first. In my opinion, I believe Tesla's biggest risks in the short term are macro risks that are outside of Tesla's control. For example, if you look at Tesla's most recent earnings here, you can see Tesla's total vehicle deliveries grew 27% year over year. This vehicle delivery growth is much lower than the previous quarter's vehicle delivery growth. In the same quarter, Tesla's revenue grew 43% year over year. Operating income grew 88% year over year. Operating cash flow grew 11% year over year, and its free cash flow stayed flat. On a trailing 12 months basis, you can see Tesla's total vehicle deliveries, operating cash flow, and free cash flow had been growing consistently for many quarters. Tesla's most recent vehicle delivery growth slowed down a lot, mainly because of the COVID shutdowns in Shanghai. Tesla's Shanghai factory was shut down for the majority of the quarter. Tesla's Shanghai factory is most important because it makes the most Model 3 and Model Y EVs for the Chinese market and the European market. The biggest risk here is this: if there are more COVID lockdowns in China, Tesla's Shanghai factory could shut down again. This is outside of Tesla's control. In the recent quarter, you can see Tesla's gross margin and operating margin decreased a lot compared to the previous quarter. This is because of the COVID shutdowns in Shanghai, inflationary pressures such as high raw material costs, high commodity costs, high logistics and expediting costs, and other supply chain issues. Tesla sold 75% of its Bitcoin holdings and lost money in Bitcoin. All these supply chain issues, chip shortage, labor shortage, and high inflation costs are still ongoing. This means they will still impact Tesla's gross margin and operating margin for at least the next several quarters until most inflation and supply chain issues are resolved. This is from the most recent earnings. In Q2, we achieved record production rates across the company. However, we saw a continuation of manufacturing challenge related to shutdowns, global supply chain disruptions, labor shortage, and logistics and other complications, which limited our ability to consistently run our factories at full capacity. This is from the Wall Street Journal. Tesla, like much of the auto industry, has been hiking prices as suppliers request more for their products. US customers who ordered the long-range version of Tesla's Model Y compact sport utility vehicle in late June could expect to pay around $68,000 or some $14,000 more than they would have if they ordered the model a year earlier. Now, all the automakers face the same macro risk as Tesla. Despite all the macro risks I just mentioned, Tesla still achieved an operating margin of 14.6% in the most recent quarter here. Based on what I know, this is one of the highest operating margins in the industry and the highest in the EV industry. In my opinion, this shows that Tesla's management has done an exceptional job working with suppliers, managing all the supply chain issues and high inflation costs, using fewer chips than before, rewriting its software to use different chips instead of relying on one supplier, and passing high costs to customers without impacting the demand for Model 3 and Model Y. Elon Musk did say that he will lower Tesla EV EV prices to make them more affordable once inflation comes down. Hopefully this will happen soon. I believe the second biggest risk is increasing competition, especially with EV makers in China. At the time of making this video, Tesla is still the largest EV maker in the world. For example, in the last 4 quarters, Tesla had already delivered 1.1 million electric vehicles. Most of them were Model 3 and Model Y. In my opinion, I believe it will be very hard for traditional automakers such as Volkswagen, Toyota, GM, Ford, Mercedes-Benz, and BMW to compete with Tesla in mass manufacturing EVs. This is because traditional automakers still make the most profits from selling millions of internal combustion engine cars every year. It is very hard and capital intensive for them to switch from making traditional internal combustion engine cars to making EVs entirely, because they will lose billions of dollars upfront in developing their own EVs and mass manufacturing them. For example, if they switch to making EVs entirely like Tesla, they will need to invest billions in research and development upfront, develop their own EV tech and battery tech, develop their own autonomous driving tech in order to stay competitive, and invest billions in large factories so they can mass manufacture EVs. It's much easier for automakers to make their own EVs in very small quantities, but it's much harder to manufacture more than 1 million EVs a year, achieve economies of scale, reduce the cost for each EV, reduce the battery cost, and make profits from them. The battery cell is always the biggest cost for EVs. This is why all the pure-play EV makers such as NIO, XPeng, Lucid Motors, and Rivian continue to lose billions every quarter. To put it simply, these EV makers have not achieved economies of scale yet. In my opinion, I believe Tesla's biggest competitors are the Chinese automakers and battery makers that have already achieved economies of scale in mass producing EVs at very low costs. For example, if you look at this ranking here, you can see Tesla has many competitors in China. Tesla's top competitors such as Wuling Hongguang and BYD either sell very cheap EVs that target the low-end market, or they also sell plug-in hybrid electric vehicles. In comparison, Tesla only makes premium battery electric vehicles such as the Model 3 and Model Y. Here's the important part. You can see BYD is becoming Tesla's biggest competitor and the largest plug-in vehicle maker in China. Also, according to this article, you can see BYD was the second largest EV maker in the world in the first half of 2022. SAIC Motor and Volkswagen were the other largest EV makers. Going forward, I believe BYD will be Tesla's biggest competitor in China because BYD has already achieved economies of scale in mass producing EVs. BYD is one of the largest battery makers in the world. BYD is also backed by Warren Buffett. According to Morningstar, Tesla has a narrow economic moat because of Tesla's intangible assets such as branding, EV tech, battery tech, and autonomous driving tech, and Tesla's cost advantage known as economies of scale. This from Morningstar. Tesla's moat stems from 2 of our 5 most sources: intangible assets and cost advantage. The company's strong brand cachet as a luxury automaker commands premium pricing, while its EV manufacturing expertise allows the company to make its vehicles cheaper than its competitors. In my opinion, I believe Tesla has a medium economic moat because Tesla has a vertically integrated business that's more efficient than most competitors. Tesla owns its gigafactories and has already achieved economies of scale in mass manufacturing EVs. It's very hard for other competitors to copy Tesla's vertically integrated business, especially its gigafactories. For example, Tesla has a Fremont factory and a Shanghai factory that can already produce more than 1 million EVs a year. On a trailing 12-month basis, Tesla has already delivered 1.1 million EVs mainly from its Fremont and Shanghai factories. Tesla is expected to deliver about 1.4 million to 1.5 million vehicles this year, assuming there are no more COVID lockdowns in China or other major supply chain issues. Based on what I know, no other companies can match Tesla's gigafactories in mass manufacturing electric vehicles yet. BYD is likely the closest one. Volkswagen will also be a major competitor to Tesla. At the time of making this video, Tesla is starting to ramp its productions in its Texas factory and Berlin factory. In my opinion, I believe it will be a matter of time, around 12 months or more, before the Texas and Berlin factories can be as efficient as the Fremont factory. Elon Musk said this. He believes that Tesla's long-term economic advantage is mass manufacturing because it's extremely hard to build large and efficient factories, mass manufacture EVs, bring down the cost of each EV and make profits from them. In last year's annual general meeting, Elon Musk said, "It's hard to build a factory. I've said many times that prototypes are easy. Production is hard. It's like 1% inspiration, 99% perspiration. But I think for production, it's like 99% perspiration. Tesla's long-term competitive advantage will be manufacturing because all cars will be electric. Eventually, all cars will be autonomous. The thing that's the hardest to, I think, sort of match Tesla on or copy is manufacturing. And so I think that will be the long-term advantage of Tesla. In the most recent earnings call, Elon Musk said this: "We're super pro manufacturing here at Tesla. And in general, we want to encourage other companies to be super pro manufacturing. And in general, I think it's a very important thing to do. We need to make stuff and make it efficiently, and that's manufacturing." In terms of long-term business prospects, I want to show you Tesla's estimated vehicle deliveries between now and 2030. Tesla's management gave this guidance: "We plan to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. The rate of growth will depend on our equipment capacity, factory uptime, operational efficiency, and the capacity and stability of the supply chain. While we continue to execute on innovations to reduce the cost of manufacturing and operations, over time we expect our hardware-related profits to be accompanied with an acceleration of software-related profits." In the short term, Tesla is aiming to achieve 50% vehicle delivery growth in 2022. This means Tesla should deliver about 1.4 million to 1.5 million vehicles in 2022, up from 936,000 vehicles in 2021. This assumes no more COVID shutdowns in Shanghai and other major supply chain issues. Management said this, and finally, despite losing more builds in Q3 than expected, we are still pushing to reach 50% growth this year. This target has become more difficult, but it remains possible with strong execution, and as Elon mentioned, no more force majeure events for the balance of the year. Elon said this from the most recent earnings call: "We have had many 30,000 car weeks already, so I think 40,000 car week is within reach by the end of this year." If Elon Musk is right, Tesla is already producing about 30,000 vehicles a week or 1.56 million vehicles a year if we analyze it. If the Texas factory and Berlin factory continue to ramp, which is only a matter of time, then Tesla will likely produce about 40,000 vehicles a week by the end of 2022. And if we analyze 40,000 vehicles a week, then Tesla should be able to produce about 2.08 million vehicles in 2023. This means we should expect Tesla will deliver about 1.4 million to 1.5 million vehicles in 2022, and possibly 2 million vehicles in 2023. This assumes there are no large supply chain issues and COVID shutdowns in China. In terms of long-term vehicle delivery targets, Tesla's management is aiming to sell 20 million electric vehicles per year by 2030. Tesla's management said this in last year's annual meeting. As we have disclosed in our impact report this year, by 2030, we are aiming to sell 20 million electric vehicles per year and deploy 1,500 gigawatt hours of energy storage per year. Our mission is clear. In my opinion, I believe delivering 20 million EVs per year by 2030 is a very aggressive target. This means Tesla will need to build more factories, make each factory a lot more efficient, buy a lot more batteries from suppliers, mass manufacture its own 4680 battery in its gigafactories, and bring down the cost of each EV so more people can buy Model 3, Model Y, and the upcoming Cybertruck. I want to show you this estimate here based on Tesla's long-term target. I believe this is a perfect case scenario for Tesla. To achieve 20 million EVs per year by 2030, Tesla will need to grow its annual vehicle deliveries by about 50% each year over the next 3 years, which I think is very achievable. Then Tesla will need to grow by about 40% each year for 3 more years, and 35% each year for another 3 years. If Tesla can execute this long-term goal perfectly, then Tesla may be able to sell 20 million EVs per year by 2030 or later. Realistically, I believe Tesla has a bigger chance of achieving a 50% average annual growth in vehicle deliveries over the next 3 to 5 years. Based on my estimates here, I believe Tesla selling 1.4 million vehicles in 2022, 2 million vehicles in 2023, and 3 million vehicles in 2024 are much more achievable. It would be very nice if Tesla can sell 20 million vehicles a year in 2030, but I'm not going to bet on it. Elon Musk said this in the most recent earnings call. He said that the demand for Tesla's EVs is not the problem. The biggest problem has always been production or mass manufacturing. No, I think we have said this now for many years. I know has proven true. Tesla does not have a demand problem. We have a production problem. It's always been a production problem. I think that will remain the case. I want to show you how to calculate Tesla stocks intrinsic value here so you know when Tesla stock is overvalued, fairly valued, or undervalued. If you want this calculator, you can download it in my Patreon blog in the video description. These are the key assumptions in this calculator. First, I define Tesla's intrinsic value as its future free cash flows discounted to the present day. The discount rate is 10%. This is slightly higher than the 8.8% cost of equity from Finbox.com. Tesla's most recent 12 months of free cash flow is $6.95 billion. Based on the biggest risk and the long-term business prospects I talked about earlier, I expect Tesla's free cash flow will grow at a compound annual growth rate CAGR between 40% and 60% over the next 5 years. This from Seeking Alpha. You can see Tesla's forward annual growth rates are expected to be between 43% and 76% over the next 5 years. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're using compound annual growth rate CAGR of 40% over the next 5 years. If we forecast Tesla's free cash flow for the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around $586 billion for the entire company, or $507 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're using compound annual growth rate CAGR of 50% over the next 5 years. Then Tesla's intrinsic value should be around $820 billion for the entire company, or $710 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're using compound annual growth rate CAGR of 60% over the next 5 years. Then Tesla's intrinsic value should be around $1.1 trillion for the entire company, or $973 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $725 per share before the upcoming stock split. This means I believe Tesla stock is substantially overvalued at the time of making this video. Morningstar has given Tesla a fair value of $760 per share. So will I buy Tesla stock? My answer is it will depend on the stock price. I already have Tesla stock in my growth stock portfolio here. This is one of my stock portfolios. I actually bought more Tesla shares recently during the large correction here because I knew Tesla stock was undervalued based on my intrinsic value calculations. My strategy is this: if Tesla stock drops below my intrinsic value estimates, I will buy more Tesla shares for the long term because I like Tesla's economic moat, its vertically integrated business model, and its long-term business prospects. However, if Tesla is overvalued by around 35% to 50%, I will likely sell a portion of Tesla shares to take some gains. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.